Did you know that the simple act of helping a struggling family member or selling an old piece of property could instantly flag your file with the IRS or the VA, triggering a review that might wipe out every dollar of benefits you rely on? This isn't about committing fraud. This is about making common, completely innocent financial decisions that federal agencies view as disqualifying moves. The IRS and the Department of Veterans Affairs have quietly tightened their scrutiny on 20 specific financial transactions, and if you've made even one of them in the last few years, you need to understand the immediate danger to your eligibility. We are talking about benefits that cover health care, housing, income support, and aid for the elderly and disabled. The rules are complex, the penalties are severe, and ignorance is not a defense. Let's dive right into the 20 financial moves that could instantly ruin your benefits, starting with the biggest trap of all, the gift-giving game. The first move that triggers an immediate red flag is unreported or excessive gifting of assets. Many people assume they can simply shift assets to their children or grandchildren to meet asset limits for programs like Medicaid or the VA's aid and attendance benefit. The problem isn't the gift itself, it's the timing and the amount. Specifically, the VA has a 3-year look-back period. If you transferred a significant sum, say $50,000 to your daughter to help with a down payment, within those 36 months, the VA doesn't just ignore it. They calculate a penalty period. This penalty period is the time during which you are completely ineligible for benefits, calculated by dividing the gifted amount by the maximum annual pension rate. If you gave away too much, you could face years of disqualification, leaving you high and dry when you need that assistance the most. This is crucial. The IRS may also require the recipient to file a gift tax return if the amount exceeds the annual exclusion threshold, creating a paper trail that both agencies can cross-reference, confirming the transfer and the subsequent benefit application. It's a double whammy of scrutiny, often initiated by a seemingly harmless act of generosity. The second critical error that flags files immediately is the transferring of home equity to non-spousal family members. Your primary residence is usually an exempt asset for most means-tested benefits, meaning owning your home doesn't usually count against your asset limit. But here's the trap. If you suddenly decide to add your adult children to the deed or sell the home to them for significantly less than fair market value, you've just converted an exempt asset into a countable transfer. If the VA determines that the transaction was solely for the purpose of decreasing your countable net worth, they will treat the difference between the fair market value and the sale price as a disqualifying gift. Imagine your home is worth $300,000 and you sell it to your son for $100,000. That $200,000 difference is now a disqualifying transfer, potentially generating a penalty period that could last longer than 5 years, depending on the average cost of care in your region. This move often looks like legitimate estate planning, but to the VA, it looks like asset hiding, and they will come after that benefit eligibility with extreme prejudice. Third on the list is converting countable assets into non-countable annuities or trusts without proper structuring. This is the sophisticated version of the gifting mistake, and it's a favorite target for compliance reviews. People try to shield assets by pouring money into complex financial instruments. While certain types of irrevocable trusts or Medicaid-compliant annuities are permissible, the vast majority of DIY or improperly structured financial products are not. If you liquidate a $150,000 investment portfolio and immediately purchase an annuity that pays out over a short period, the VA or Medicaid may look right through that structure. If the annuity is not actuarially sound, meaning the payments are structured to last longer than your life expectancy, the entire purchase amount can be treated as an illegal asset transfer. The moment that large lump sum transfer hits the financial records, the flag goes up. They don't just deny the application. They often require detailed documentation proving the intent and structure of the entire financial product, leading to months of stressful back and forth. The fourth financial move that spells disaster is cashing out life insurance policies with significant cash value. Term life insurance is usually fine, but whole life or universal life policies build up cash value, and that cash value is generally considered a countable asset. If your policy has $60,000 in cash value and you need to get below a $150,000 asset limit for VA benefits, you might think cashing it out solves the problem. But where does that $60,000 go? If you cash it out and the money sits in your checking account on the first of the month when your eligibility is calculated, you're still over the limit. Worse, if you cash it out and then immediately spend it on non-essential items like a luxury trip or a new car for a relative, the agency will look at the sudden dissipation of that asset. If the funds cannot be accounted for as legitimate expenses, like medical bills or home modifications, the agency treats the unaccounted funds as an improper transfer, triggering the same penalty rules as excessive gifting. The movement of that large sum from the insurance company to your personal account is the digital signal that alerts the auditors. Fifth, beware of shakma, lump sum repayment of existing debt to family members or friends. This move seems benign. You owed your sister $25,000 from years ago, and now that you need to reduce your assets, you pay her back. If you have documentation proving the original loan, a signed promissory note, records of the initial transfer, it might be fine. But if you suddenly transfer a large sum to a relative without any formal arm's-length loan agreement, the IRS and the VA will almost certainly view that transaction as a disguised gift. The assumption is that you are transferring money out of your name to qualify for benefits, labeling it a debt repayment to avoid the look-back penalty. If you cannot provide clear, verifiable evidence that a bona fide debt existed, the entire repayment amount is immediately counted as a disqualifying transfer, triggering the penalty clock and potentially subjecting the recipient to unexpected tax liability if the IRS views it as unreported income. Now let's pivot sharply from asset transfers to income reporting, where the IRS often initiates the flags that the VA then picks up. The sixth financial move that ruins benefits is failing to report small amounts of 1099, Mes-C, or gig economy income. Many people receiving Social Security, SSI, or VA pensions rely on these benefits, and they might pick up a small side hustle, selling crafts online, doing a few deliveries, or consulting occasionally. If you earn over $600 from any single source, you receive a 1099 form, and the IRS receives a copy too. If you think that $800 or $1,500 won't matter, you are gravely mistaken. The moment the IRS processes that 1099 and sees you didn't report it on your personal return, they flag your file for discrepancy. If you are receiving means-tested benefits, that additional income, however small, can push you over the eligibility threshold, resulting in an overpayment demand. The VA and Social Security Administration, SSA, regularly cross-reference their benefit rolls with IRS data. That $800 of unreported income can lead to a demand for repayment of thousands of dollars in benefits, received while you were technically ineligible. Seventh, watch out for BIN, improperly reporting dividend or interest income from jointly held accounts. This is a common mistake for older couples or individuals who share accounts with adult children for ease of management. If your name is on the bank account or brokerage statement, the IRS attributes all the interest and dividends to you, even if you claim the money is actually your child's. If you are receiving VA benefits or SSI, that imputed income can easily disqualify you. You must meticulously track and document the true ownership and distribution of that income. If the IRS sends a notice stating you underreported income based on 1099 INT forms, that notice is automatically shared with benefit agencies, triggering an eligibility review based on a sudden, unexplained increase in your reported income. The simple fix is often to remove your name from accounts where the assets and income truly belong to others, but failing to do so is a guaranteed flag. The eighth dangerous move is HIDA, taking early or unplanned distributions from retirement accounts. A 401k or IRA is generally not counted as an asset for VA benefit eligibility until you start taking mandatory distributions. However, if you suddenly decide to withdraw a large lump sum before retirement age, say $40,000 to pay off a loan, that money immediately converts from a protected asset into countable income. Not only does the IRS hit you with a massive tax bill and potentially a 10% early withdrawal penalty, but that withdrawal is also treated as income for the year by the VA and SSA. If that income pushes you over the annual income limit for your specific benefit program, you are disqualified for that year and potentially liable for repaying benefits received while you were ineligible. The 1099-R form generated by the withdrawal is the digital notification sent directly to the IRS, which then funnels the data to the benefit agencies. Ninth, be extremely careful about selling highly appreciated assets and failing to account for capital gains. If you sell stock, cryptocurrency, or a piece of land that has significantly increased in value, the profit is a capital gain, and that gain is considered income by the IRS and, critically, by many benefit programs. Let's say you sell stock you bought for $10,000 for $70,000. That $60,000 gain is taxable income. If you are receiving benefits, that large, sudden influx of income can immediately disqualify you for the entire year. Many people think, I'll just reinvest the money, but the moment the sale is executed, the income is realized. If you fail to properly report the capital gain on your tax return, the IRS will flag the discrepancy based on the 1099-B form from your broker, and the resulting audit will inevitably lead to a benefit review. This is especially true for VA recipients who must maintain a low net worth and income level. The 10th move, which often catches people receiving housing assistance or SSI, is just unreported rental income from a secondary property. If you own a duplex or rent out a basement apartment, that money is income. Even if you are paid in cash, you are required to report it. If you fail to report this income and the IRS later discovers it, perhaps through a tip, or if the renter claims the deduction on their taxes, the resulting audit is devastating. Not only will you face back taxes, penalties, and interest, but the benefit agencies will retroactively calculate your eligibility using the newly discovered rental income. For someone on SSI, that income could mean months or even years of overpayments that must be repaid, often leading to garnishment of future benefits. The paper trail created by leases, utility bills, or even maintenance invoices can be enough to establish the existence of the unreported rental activity. Moving into the realm of real estate and property transactions, the 11th financial mistake is converting investment property to personal use immediately before applying for benefits. As mentioned, your primary residence is generally protected. Investment properties, however, are usually counted toward asset limits. If you own 3 rental properties and suddenly move into one just before applying for VA aid and attendance, the agencies will scrutinize that move. If it appears the sole purpose was to reclassify a countable asset as an exempt asset, they may look through the transaction. More dangerously, if you sell the investment property and immediately use the proceeds to purchase a new, more expensive primary residence, the agencies will trace the flow of funds. If the cost of the new home significantly exceeds the value of the exempt portion of your previous residence, the excess funds used in the purchase might be viewed as an improper use of assets, especially if the transaction occurs during the look-back period. 12th, beware of selling property to a buyer who assumes the mortgage or provides owner financing. This creates a complex stream of income that is easily misreported. When you sell a property and hold the note, meaning the buyer pays you monthly, those monthly payments are part interest and part principal. The interest portion is taxable income, and it is also countable income for benefit purposes. If you fail to report this ongoing stream of interest income, or if you structure the deal informally without proper documentation, the IRS will flag the lack of reporting, and the benefit agencies will see an unexplained regular deposit into your bank account. This regular income stream can quickly push you over the monthly limits for programs like SSI or VA pensions, leading to immediate suspension of benefits and a demand for repayment of past funds. The 13th move is taking out a reverse mortgage or home equity line of credit, HELOC, and mismanaging the proceeds. A reverse mortgage or HELOC loan itself is generally not considered income, as it is a debt. However, the proceeds become a countable asset the moment they hit your bank account. If you take out a $100,000 HELOC and let that money sit in your savings account for 3 months, you have $100,000 in countable assets, potentially disqualifying you from means-tested benefits. The VA and SSA are keenly aware of the use of reverse mortgages as a financial planning tool. The moment the lending institution reports that large disbursement, the financial trail is established, and the burden of proof is on you to show that the funds were immediately spent on exempt purposes, like medical care, or properly structured to avoid asset limits. 14th, a major trap is using benefit funds to purchase or invest in non-exempt assets. Many benefits, like SSI or VA disability payments, are intended for specific purposes, living expenses, care, etc. If you receive a large lump sum of retroactive benefits and then use that money to purchase something that is considered a item countable asset, like a second car or a large amount of stock, that asset immediately counts against your eligibility limit. For example, if you receive $15,000 in retroactive SSI benefits and use $10,000 to buy a rare coin collection, that collection is now a countable asset. If that purchase pushes your total assets over the $2,000 limit for SSI, you are immediately disqualified. The agencies track the deposits and subsequent large withdrawals, and if the purchase cannot be justified as essential living expenses, the asset is counted. Now let's look at common mistakes involving retirement and investment accounts, starting with the 15th flag. Rolling over a retirement account into an inherited IRA and failing to take required minimum distributions, RMDs. When you inherit an IRA, the rules change significantly. If you are a non-spouse beneficiary, you must generally liquidate the account within 10 years, or if you qualify as an eligible designated beneficiary, take annual RMDs. If you fail to take these distributions, the IRS hits you with a massive penalty, often 50% of the amount you should have withdrawn. That IRS penalty notice is a huge red flag. Furthermore, the RMDs themselves are considered taxable income and countable income for benefit eligibility. If you try to avoid the income by avoiding the RMD, the resulting IRS scrutiny will inevitably lead to a benefit review where the agencies discover both the income potential and the non-compliance. 16th, be cautious of over-contributing to tax-advantaged accounts like HSAs or IRAs while receiving benefits. While contributions to these accounts are usually encouraged, if you are receiving SSI or certain other benefits, your ability to contribute may be limited by your earned income. If you over-contribute to an IRA, the IRS must be notified, and the excess contribution is subject to a 6% excise tax every year until it is corrected. The moment the IRS levies that excise tax, your file is flagged. Moreover, if the contributions are coming from an undisclosed source of income, The agencies will use the contribution record to uncover that unreported income, leading to an immediate benefit review and potential clawback of past payments. The 17th financial move that triggers scrutiny is liquidating cryptocurrencies or other digital assets without accurate basis reporting. The IRS is intensely focused on digital assets. If you sell Bitcoin or Ethereum, the profit is a capital gain, just like stock. But because digital assets often lack the clear 1099-B reporting of traditional brokers, many people mistakenly believe they don't have to report the transaction. The IRS uses advanced analytics to track these transactions, and if they catch an unreported sale, they will assume a zero basis, meaning the entire sale price is treated as profit. This massive sudden increase in imputed income will not only lead to a huge tax bill, but will also instantly disqualify you from means-tested benefits for that year. The sheer volume of the transaction, even if eventually proven to be mostly principal, is enough to initiate a full-scale IRS audit, which always includes a cross-check with benefit agencies. Moving to business and self-employment issues, the 18th major mistake is to structuring a small business as a hobby to avoid reporting income and self-employment tax. If you start a small consulting business or sell items online and you consistently generate a profit, the IRS views this as a business, not a hobby. You must report the income on Schedule C and pay self-employment taxes. If you try to categorize it as a hobby to avoid the tax and the scrutiny, and the IRS determines it is a legitimate business, they will retroactively assess taxes, penalties, and interest. Crucially, the benefit agencies will also count that net profit as earned income. If that earned income exceeds the limits for your benefit program, you face an immediate suspension and a demand for overpayment, often dating back several years. The failure to file a Schedule C is a massive signal to both the IRS and the SSA. 19th, be extremely cautious about receiving payments or compensation in the form of barter or non-monetary exchanges. If you are a skilled tradesperson and you trade your services for free rent, or if you exchange consulting work for a new car, the fair market value of that barter is considered taxable income. If you fail to report the value of that exchange, you're underreporting your income. For benefit purposes, the value of that barter is also countable income. For example, if you receive $1,500 worth of services in exchange for your work, that $1,500 is added to your monthly income calculation. If that pushes you over the limit for SSI, you are disqualified. Since there is no paper trail, agencies often rely on bank records showing a lack of necessary expenses. E.g., you live rent-free but report no income, which triggers suspicion and eventually an audit where the barter arrangement is uncovered. Finally, the 20th financial move that can ruin your benefits is failing to properly report the acquisition or disposition of foreign assets or accounts. The IRS has become hyper-aggressive in enforcing reporting requirements for foreign bank accounts, FBRR, and foreign assets. If you have any financial interest in or signature authority over a foreign financial account exceeding $10,000, you must file FinCEN Form 114. If you fail to do this, the penalties are astronomical, often reaching hundreds of thousands of dollars. The IRS's pursuit of foreign asset non-compliance is a massive undertaking, and if they flag you for FBAR violations, the sheer volume of unreported assets and income immediately triggers a full review by all federal benefit agencies. Even if the foreign assets are technically non-countable under certain domestic benefit rules, the existence of undisclosed wealth automatically raises the highest level of suspicion regarding your true net worth and income, leading to a complete, intrusive audit of all your financial affairs. The risk here is not just losing benefits, but facing life-altering financial penalties and potential legal jeopardy. These 20 moves are not obscure legal technicalities. They are the everyday financial decisions that millions of people make, often with the best intentions, but without understanding the fine print of federal benefit eligibility. Remember, the VA and the IRS operate on a principle of information sharing. A transaction that triggers a tax form, a 1099-B, a 1099-R, a Schedule C, immediately creates a data point that can be cross-referenced with your benefit application. The moment you transfer assets, realize a significant gain, or start a new income stream, you must pause and ask, how will this look to an auditor reviewing my eligibility? The core takeaway is simple. Transparency is mandatory. If you are relying on means-tested benefits, every financial transaction that moves assets out of your control or brings income into your household must be meticulously documented and structured to adhere to the strict asset and income limits. Don't let a moment of generosity or a simple misunderstanding of tax forms cost you years of vital support. Review your past 3 years of transactions now, identify any of these 20 red flags, and consult a professional immediately to mitigate the damage before the agencies send that dreaded notice of proposed adverse action. Staying compliant isn't just about avoiding penalties. It's about protecting the safety net you deserve.